Hey everyone, in this video I'm going to be talking about whether you should be buying apartments or whether you should be buying houses. And then even more importantly, I'm going to be talking about how an area that you think makes for a good investment may not actually for a good investment and how to actually tell. Okay, so my name's PK and I help people build passive income by buying properties that have the combination of positive cash flow and capital growth without dropping 15K on a buyer's agent, without flying around the country doing inspections, and without spending time on realestate.com. All right, so let's get into it. So many of you have been telling me that, okay, PK, I only have three, four, $500,000. I live in Sydney or I live in Brisbane. Where should I actually invest? All I can invest in are, in fact, apartments. There's nothing else I can do. Well, this video, I want to dispel that myth because if you are not opening yourself up to all 15,000 property markets, in other words, property suburbs, then you're not really doing yourself a service. In fact, you're doing a disservice because you're looking at property investing only in your backyard, only in the local government area in which you live, or only in the city that you live. All right. So if this video is something that you actually want to delve into, you will get value out of, then if you're watching on YouTube, smash the subscribe button, hit the notification bell, give it a thumbs up. That way this video goes out to more and more people. And if you are watching in my Facebook group, welcome. If you're not, get in that Facebook group. There's more than 7,000 people in there, and it's a fantastic community to grow and learn about property investment completely free of cost. All right, so let's get into it. So I'm going to start with a case study. So apartments versus houses. And more importantly, alongside that, good suburbs that you may think are good versus actually good suburbs from a data perspective. So let's go into a case study. So I've made some notes. I'm going to kind of read a little bit from them. The case study is West End or South Brisbane in Queensland. So if you are from Brisbane, you know what I'm talking about, West End. If you're from Melbourne, think of this like the Docklands or the South Bank version of where you are. If you're in Sydney, then this is kind of like inner city apartments, or even St. Leonard's, Lane Cove, or Lower North Shore, not houses, but high-rise apartments. But let's stick to West End. And if you're in one of those other cities, this is kind of the comparable. All right, so over the decade ending 2020, Brisbane was the fastest growing capital city in terms of population growth. However, if you bought an apartment in West End or in Brisbane, South Bank, or South Brisbane as we call it here, you would have made about 10 or 15% capital growth. So population growth was huge. You wouldn't have made that much money from a capital growth perspective. Now, you're probably thinking, why is that, right? There are great restaurants in West End or South Brisbane. There are great river walks. There's a great museum, some world-class theatre. There's a great public school where a lot of people want to send their kids to. There's the state's biggest convention center. There's so much in the making. A new university is right across the river. So these are all the things that you would ordinarily think make for a great suburb to invest in property, right? It's got that vibe, lots of cafes, lots of young people. You drive around, you see lots of Audis and all that kind of thing. You would think that this would make a fantastic place to invest in, right? But actually it doesn't. All right. So like I said, if you bought a $500,000 apartment in South Brisbane or West End 10 years ago, that would be worth maybe 10 or 15% more now, 10 years later, than it was then. And so you're probably thinking, but what have I done wrong? There's a university, there's a great school, there's parks, there's shopping centers, great walkways, great family amenity, all that kind of thing. What have you done wrong? You haven't looked at the data. And right, like I want to really emphasize this point. If you're thinking about an apartment, guys, I would almost never advise you to buy an apartment. And the reason is, the single biggest reason is that they're not making any more land but there is unlimited sky. So I'll give you another example. Like right after the Olympic Games in Sydney, there was a big hoo-ha. Now Sydney's on the world stage. It's a great city, world city, all this kind of thing. And they were building World Square. Now, if you are from Sydney, you know that this is right, downtown. World Square is like one of these really high-rise apartment blocks, and they were selling apartments back then in World Square for about $500,000, or just shy of $500,000. And so many investors bought there. So many investors bought there thinking it's smack bang in the middle of the CBD. How can you go wrong, right? And tell me if you're thinking about this as well. You're like, PK, I've got $500,000 to spend and can't buy a house, and I don't want to buy a house in Sydney with that money. I can't anyway, and neither can I in Melbourne. I have an opportunity to buy an apartment. Let me buy in Darling Harbour, or let me buy an apartment in the CBD. Let me buy an apartment on North Sydney, or in the Brisbane context, West End, South Brisbane, or in the context of Melbourne, Docklands, South Melbourne, Yarra. All these areas, you're probably thinking, what can go wrong? There's great amenities, great population growth, more and more and more and more people are going to want to live there. What can go wrong? Fundamentally, guys, it's supply that you're missing out. You've missed the supply story. The reason why I never buy apartments is because you can simply build more and more and more as high as you like. Okay, so let's say there's 10 skyscrapers right now. The council can rezone that CBD area and allow another 10 skyscrapers. Now, 10 skyscrapers with, filled with residential apartments, that's like 500 apartments per skyscraper. Another 10 of them, or even another 2 of them, is creating so much more supply that you're simply not going to have any scarcity in the investment property that you own. I'm sure you know of those buildings where there's always, something for rent, or always something for sale. And that's what you're buying when you're buying an apartment. You're buying something that is a commodity. Whereas if you're buying a house, something with a block of land, that is what will become scarce. All right. And of course, the science of property investing is to find a block of land, something that has a land component where the data suggests that demand is higher than supply. So I just want to really emphasize that point, that regardless of how great a place is, regardless of how much you yourself would like to live there, like there's probably a lot of you who are in your 20s and your 30s, young couples, young families, you're like, I would love to live in South Yarra. I would love to live in West End. I would love to live in South Brisbane. Look, there are nice places to live, but that doesn't mean that they make for good property investment locations. All right, guys? So in the last 10 years, I hope that you can look at the data and say, I should never buy an apartment in any of these inner city areas. Now, sometimes it's okay to buy an apartment, let's say, in a low density complex, especially in Sydney and Melbourne, especially in Melbourne, actually. You have these kind of areas, maybe 5-10 kilometers from the CBD. It's kind of like an old flat. It was built in this, perhaps the 70s or 80s. There's no elevator, there's no body corp, there's no gym, there's no like sinking levy or anything like that. It's very ordinary. You just take stairs up and down. There's maybe 2 or 3 or 4 of them in the complex. They're all ground level. Those actually can make for some pretty decent investments because the land to asset ratio is high. In an apartment, the land is 0. There is no land, so there is no land to asset ratio. Remember, land is what appreciates, and it is buildings that depreciate. So when you're buying an apartment, you're buying like a brand new Mercedes out of the dealership. As soon as you've bought it, it's depreciated, right? Because there's no land. It's land that actually goes up in value. So I hope that you're connecting with this point. Apartments versus houses. You should always, always, always buy houses. And like I said at the start of the video, if you're sort of thinking, hey, I can't afford houses, like, who has that kind of money? Look outside your backyard. So if you're in Sydney or in Melbourne watching this, you could have invested in Ballarat and almost doubled your money in the last 4 years. You could have invested in Bendigo and made 30-40% over the last 2 years. If you're in Sydney, you could have bought in orange and basically, 70% capital gains just in the last 3 years. You could have invested in so many of these areas that have grown up so much as long as you were able to take a wider lens and look outside your backyard. So hopefully this is sinking in, guys. And the other thing with apartments as well, right, is you have that body corp, you have that sinking levy. So although the yield on the face of it looks really good, right, you might be seeing an apartment and the person who's selling it off the plan, is saying, look, you're going to get a 6%, 7% yield, and you're like, I can't get that in houses. Like, there's no way I can get that in houses. Actually, the net yield will be much lower because you're paying body corporate, or strata fees. They really take that gross yield way down in terms of net yield, and the net yield is very comparable with houses. So why would you buy an apartment? The yield story isn't actually as good as houses once you kind of lift up the lid and really understand what's going on. The capital growth story isn't as good as houses. You can't add that much value to apartments either, because you can only add value cosmetically inside, not on the outside in many instances. So there's not a whole lot that's actually working for apartments at all. You can't subdivide or any of that stuff. So I just want you to connect with this point really good. So investors who mistake so-called good neighborhoods for fundamentals, good neighborhoods equal fundamentally good investment locations, they miss the point entirely. Where you should invest has got nothing to do with how much you would like to live in that area. Where you should invest needs to be looked at from an investment angle, and the best investment angle is data. So think about things like land to asset ratio. Think about things like the days on market. Think about the things like how much rents have been going up. Think about things like net yield. Think about things like the development land schemes that are in those areas so that supply won't go up. Think about things like building approvals, right? Like if you just looked at this one factor, building approvals, you would not have spent a single cent buying an apartment in any of the capital cities over the last 8 years, because the building approvals were just far too big. Supply is the enemy of growth. Even if population booms, if the supply catches up or keeps up with that growth, capital growth or prices don't increase. It's simple economics. So look, I won't labor that subject too much anymore. But basically, what I'm trying to say is, if you only have $400,000, $500,000, never go near an apartment. Always stick to a house. Always prioritize capital growth. Always prioritize yield. Don't even buy one property that is capital growth and then one that is for yield. Always have the combination of growth and yield in the same property, and that is how true passive income is built. All right, guys. Well, hopefully my ramblings help today. There's so much more to be said, actually, about apartments and the fallacies of owning one. It just seems like a natural thing to do, right? Apartments, of course, brand new apartments, that's what we should be buying. But it's really not true. So hopefully that added value. If it did, hit the like button, hit the love button, give me a thumbs up, subscribe, turn the notification bell on, and tag someone that is about to make that mistake or could benefit from this video. All right, guys, I'll leave a link below on how you can learn the data of property investing yourself, so you don't need to go to a buyer's agent, and hopefully that adds a lot of value to you guys. My name's PK, and best of luck with your property investing.